Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello everyone, my name is Debbie from NDIS Property Australia, and you're listening to the SDA Housing Podcast, a show that explains, highlights, guides and brings awareness about all things SDA in this ever-changing NDIS world. I have Min with me today as my co-host. Hi Min.
Hello, Debbie.
And today, what are we talking about?
Unlisted property trusts or funds that are investing into SDA sector.
Wow, this is a new topic for us.
Yeah, it is. We've always danced around the edges in the past about other funds doing stuff, and then the lashback from investors on the Fin Review newspapers. But why I've asked for this topic today, Debbie, with you is we're now seeing more and more groups, spruikers, companies, agencies, or whatever come into the funds management world. And, you know, Debbie, the last few years, you and I have seen pretty much everyone out there, every man and his dog, trying to sell real estate, trying to sell stuff in the SDA world, correct?
We certainly have, and the majority of them have probably gone by the wayside now. Or have they?
Well, I think they've, the new frontier is now funds management.
Yeah, they've pivoted.
Yeah. So you'll see more and more of these organizations or groups promote funds, property trusts, syndicates, or some sophisticated level of product to get into SDA. So Debbie, you and I have been in the financial services game a long time ago, back when I was a financial planner and you worked for me here as a practice manager. You recall the good old days, Debbie, don't you? You had the managed funds, which were on large mass trusts or groups out there, and then the direct retail funds and syndicates as well. They were pretty much a diversified kind of asset where you just put money in, you sit there and wait, your income every year, right? You recall those years, right?
Yeah, of course.
Yeah, and they were the alternative to investing in shares and direct stocks and share managed funds.
Absolutely.
So that world of unlisted property trusts or property syndicates, we're very familiar with from our past history. And the important thing is, Debbie, it has to be a good asset behind it, attached to it, and good operator. They're the keys, correct?
Without a doubt. Because there are less checks and balances when it's an unlisted property trust.
Yes.
But there's a lot of good to them as well.
So why don't you talk about the positives, Debbie? Why you think people are jumping into a property trust, listed or unlisted, whatever?
Okay. Well, obviously, it allows investors to acquire commercial properties that they wouldn't typically be able to invest in on their own. So potentially it gives them access to high quality assets and markets that they might not otherwise have access to. Generally, these trusts are managed by experienced property investment managers, so all of the acquisition, leasing, maintenance, admin are sort of taken care of by those property managers. So there's no day-to-day responsibility by the investor as it would be if they had their own individual property investment. There's also regular income. They can generate income regularly because of the long-term leases to tenants, usually distributed on a monthly or quarterly basis. And often these properties are, they're good quality, so they can provide a good capital growth to the investors and can increase quite well because you're looking at properties that are often in areas that an individual investor wouldn't be able to afford to go into, hence why it's gone into a trust, and does give that benefit of having a high potential capital growth. It allows you to enter into an investment with a much lower starting point. You know, you might be able to get into something for as little as $10,000 And that gives you access to a whole portfolio of properties across various sectors. So it could be an industrial, retail, or other type commercial investments. There's tax efficiency that comes from it, less market volatility because, and this is also equally can be a negative, but because the property trusts are valued less frequently, means that there's less price volatility within the value of your asset. So there's some good positives that are around an unlisted property trust.
Yeah, but
Trust.
I mean, I love those big, sexy words, Debbie. Access to large-scale commercial property, professional management, potential for capital growth, potential for regular income.
You're saying a word potential.
Oh, I love the word potential because it means that can happen. Less volatility, tax efficiency. I mean, they're all very attractive words, I think. But unfortunately, I don't see many of these words associated with the word SDA.
Sure.
Tell me if I'm wrong. I mean, please tell me if I'm wrong here, please.
No, you're not wrong.
Okay, cool. So look, property trusts, unlisted or listed, are normally associated with commercial, industrial kind of products. Freehold, large-scale buildings, high-rises with tenants in place. They're all there. And they're normally the 7 to 10% yield kind of products the last 20 years or so out there. We've seen it. They exist. Go check it out with the guys. Opus, Cromwell, a lot of colonial first state funds out there, and all these master trust platforms and superannuation and whatnot. They're all out there, right? But when you're talking about SDA as a new sector, new market, and the frontier of capital raising for SDA in this world of, Debbie, SDA, do you call it low risk, medium risk, or high risk? What's your opinion here?
Medium to high risk.
And that's for buying an individual property.
Yeah.
One. But when you mix that with 100 or 1,000 other investors at 50 grand or 20 grand, 30 grand lump sums with much more supposed compliance of AFSL licenses or PDSs, does that make it more better or more worse, do you think? More red tape? Well, what will you tell me, Debbie?
Well, it's a much simpler investment.
Yeah.
And on the surface, it probably seems like it's a lower risk investment because your money's being, potentially spread over a number of different properties, therefore diversified. But is it really?
We are telling you this on our podcast here because we're seeing a lot more of these startup fund managers, startup asset managers convincing mum and dad investors to put money with them. Now, I'll use your common sense here, Debbie. You buying one property should be hard enough, right? But you buying with 10 other people, Debbie, you and your 9 other friends, how challenging is it to work together to decide on everything? On payments, income, paying down debt, capital, borrowing money, fees. I'm talking about 10 people here, not 1,000 people, 10 people here. How complicated is that going to be?
Very.
Yeah. So, we've had 2 podcast episodes about the last year and a half from the Fin Review, Australian Fin Review, Domicom stock. We've raised in the past already. You've seen it all. Big, massive scandal. Raised $50-60 million. Purchased $50 or $60 million, not $70 million worth of SDA houses all in Melbourne. Pretty much majority in Melbourne. And they've all lost, I think, 20 to 30 to 50% of their asset value after 4 years. And that was a stockbroking firm managed fund on a listed secondary market, and that fell apart. And these are houses as well in a rising market in Melbourne, Debbie, of all places. So we're really concerned about the new frontier of SDA marketing, spruiking in syndicates and funds and whatnot. And I'm really, really concerned.
Yeah, look, I want to just highlight a review that we came across online a few months ago now. I'm not going to name names or anything, but I'm just going to basically read out the guts of this review.
Of someone else, real company, right? Not
Yes, yeah. So this is from the reviewer. Investor beware, potential fraud and misappropriation of funds. I invested a significant portion of my retirement savings in an SDA housing development project with blank, facilitated by the asset manager. The project was never completed and the company is now in liquidation with no funds available. It appears that investor money was misappropriated for other purposes, leaving hundreds of investors, many of whom are retirees, facing financial ruin. Key concerns: misleading promises. The directors made repeated promises about project timelines and returns that were never fulfilled. Lack of transparency. The communication from the company was inconsistent and often misleading, with attempts to conceal financial difficulties and the misuse of funds. No construction progress. Despite receiving full funding for the project, there has been little to no development progress on the SDA housing site. No funds finding. The liquidators report indicates that there are no funds available in the company accounts, raising serious questions about where the invested money went. Potential misappropriation. Evidence suggests that investor funds may have been used for unauthorised purposes such as investments in unrelated ventures or to cover losses in other projects. Warning to potential investors: exercise extreme caution when considering investments with said company or any company associated with, and this person has named names. There is a strong possibility of fraud and misappropriation of funds. Do your research, seek independent financial advice, and be wary of promises that seem too good to be true. My experience: I have lost a significant portion of my life savings due to this alleged scam. I urge anyone considering investing with the company to reconsider and protect their financial future.
First of all, we feel sorry for this victim.
Very sorry.
Who's lost their money through, again, could be a scam, could be legitimate investment. I don't know. But, when you hand your money over to someone, you better make sure that you're comfortable with never seeing that money ever again. And if you don't, then you have no one to blame but yourself. And you know what? I know you're going to be angry at me, saying, but how can you say that? Well, no one's stuck a gun to their head to make them invest in a not unrelated party and lost their money. Look, when you invest money, you could make money or you can lose money. That's just common sense. Buyer beware. If you don't know, go talk to your accountant, go talk to your lawyer, go talk to your financial advisor. I want to be nice here. Don't be foolish and think that there's guarantees or there's assurities of returns or liquidity. Debbie, what does illiquidity and liquidity mean? And how important is it in the world of SDA, let alone the world of investments, please? You're seeing our first-hand investors in SDA. How illiquid is that world?
A lot of the time, not very. I mean, liquidity, obviously, you've got the ability to cash out. Illiquidity is probably something we really need to talk a lot about, especially in terms of these trusts.
And the other word for that is difficulty to exit.
Yeah, exactly. So you might be locked in to these investments far longer than you're really able to handle.
Can I jump back to the normal, everyday SDA world that we're involved with, Debbie?
Mm-hmm.
And you tell our listeners here about how difficult it is to exit from SDA housing at the moment in our past 4 years' experience, please.
Look, the only time we've seen it easy to get out of an SDA investment is if your property is tenanted and tenanted well with a good income. Then you will have buyers flocking and it will sell very quickly. But how many properties out there are fully tenanted with a good income? Not many. If you don't have any tenants, you're going to really struggle to sell it. There will be buyers, and if you're willing to take a loss, you can probably get out of it. But there's all sorts of other issues involved there in terms of location and funding difficulties. So just, having one property, one SDA property is proving to be, in many cases, illiquidity.
Well, these funds here are talking about 10, 15, 20, 30 properties, Debbie, which is 20 times worse.
Yeah, absolutely. So
good luck getting out of the syndicate you're in with hundreds, if not thousands of other investors in a portfolio of 30 to 50 houses or apartments with no liquidity at all. You can't get out of it.
Yeah. I mean, that's just the first thing to consider. It's a difficult market at the best of times. When it goes well, when it goes right, it is amazing. But it's pretty hard to get it right. And from what we've seen with these funds, they don't seem to have really done their own due diligence on what to buy where, and have ended up, as you mentioned, the Domicom situation that we've discussed in the past, and didn't take advice that they should have taken when they were buying these properties and the advice that they were given, and ended up with some really bad investment properties that they couldn't do anything with.
I think, Debbie, what are potential negatives that you can come up with in terms of these unlisted property trusts, please?
Well, obviously, illiquidity and difficulty exiting, lack of transparency.
There you go. If you don't know who you're giving money to, how can you trust them?
Yeah. How do they know? How do you know that they know what they're actually doing in this SDA space that is so complex and still so new? Potential for capital loss. As I just said, a lot of these properties, if they're not a good property in a good area, they potentially can be sold, but not for what the cost was in the first place. Here's a good one, Min. Fees and costs.
Oh my God. Can I declare to everyone here, right? This is me being a white knight in shining armor here, to telling you, the retail mum and dads, unless you totally trust the fund manager or the asset manager as a public company with great brand awareness and brand recognition, just question who you're doing business with, right? Because the purpose of a fund manager or an asset manager is to make money themselves on behalf of their client. And look, and I want to give you an example here. This is an example of, I could go on for another hour here, but I'll just keep it nice and short. Entry fees, exit fees, MER fees, buy-sell spreads, acquisition fees, development management fees, financing fees, profit margin fees. These are all the fees that I just read in a PDS of another company here who launched a new SDA fund recently. And you know who I'm talking to about. Wink, wink. I know who you are. But fees. The only guy making money here is the responsible entity investment manager, right? And I can guarantee you on the side, the investment managers are making more money on the side under the table as well. Because I've read the IM, the PDSs, and I could see the way it says potential, may receive, right? And it's clear that they're making a lot of money in fees before even the investor makes any money. And so much so that, and Debbie, let me ask this question to you, Debbie. What is the average fund manager out there in an okay market, property trusts, syndicates, managed funds, whatever? What is the return range that people expect as an investor out there? Super fund or whatever. What do you think out there is a range that people expect as an investment?
5 to 8%.
Yeah, on the low end, but the expectation-wise?
Expectations, 7 to 10.
Yeah, 7 to 10. Yeah, okay. And that's been the case for the last 10, 20 years in a conservative fund or balanced fund, Debbie, all right? So back to SDA then, what do you think a normal investor who buys one property for SDA should expect his return to be?
8 to 12.
Gross?
Yep.
Net would be?
7 to 9.
7 to 9. So again, in that 8, 9.
Yeah, so it falls into that same range.
Yes. So therefore, with all these challenges of transparency, potential capital losses, high fees, limited diversification, lack of exiting, don't you think 7 to 9 is
it's a pretty low return for all those risks?
All those risks, yeah?
Mm.
I mean, I just want to make sure that investors out there who are looking at all these funds and syndicates and property trusts are aware to read the fine print. Read every single word, because you know what? If something goes wrong, Debbie, tell me if I'm wrong here. If something goes wrong, and I was the investment manager, I'd say, but hang on, I declared it in the PDS. It's all there.
They've always got the get out clause.
It says you may lose money. It says I'm not giving any advice here. Go seek independent financial advice here. It says so. It's not my fault as the responsible entity that we've lost money. Well, in a way it is, but their get out of jail card is this is a PDS and you may lose money.
Mm-hmm.
You knew.
And you signed up based on the fact you stated you'd read everything in this and are aware of this.
You should be aware of it. You signed it all. So, ladies and gentlemen, please be very careful. I've yet to see anyone out there in a fund of funds or syndicates or property trusts make money or get exit out at a happy, comfortable, profitable outcome for SDA. I mean, I'm sure there are, but I've yet to see it. I'm just seeing a lot of bad press negativity out there. And as I said earlier, David, to you, Right now, the new frontier of SDA is funds. And I'm just concerned about the spruiking of these funds to get money into it, because it's only 50 grand, it's only 100 grand. If it's 100 grand or more, it's the wholesale funds who must meet the sophisticated rules, Debbie, and they are, what are those rules?
Sophisticated investor rules are assets of 2.5 million or income of 250,000 per annum.
Per person or per household?
Per person.
That's wholesale. Retail investors must go through a PDS AFSL license. Okay, so be very, very careful about who you seek for advice. Particularly, Debbie, transparency. Who is running the fund or the responsible entity in the background?
Absolutely.
Yeah.
Who's running it? What the fund manager's expertise is? Who's making the decisions on the whats, the wheres, the whens? We've seen so many people make mistakes just on 1 or 2 properties, but if they're investing in 20, 30, 50 of these properties and they're not diversifying it properly, which we haven't seen a lot of diversification really when we have seen these, that's, there's got to be some red flags coming up if you think about it from that perspective.
And I want to say to our podcast listeners here, right, I've now come across, and I admire their feedback, 2 podcast listeners, one who we know, we've mentioned in the past many times now, who's done a lot of SDA projects himself, doing a lot of SDA projects based off the podcast content now. And then we came across another one, Debbie, last week, a young family in Melbourne looking at doing a site in Melbourne southeast for their parents as well. And they're a big, avid, long-term positive podcast listener. And I want to say to you all who's listening to us, our podcast, and this is you who are also competitors out there who are listening to our podcast, right? We are holding back on the content of our podcast because there are some things we cannot say publicly in this online domain. Debbie, do you agree or disagree?
Yeah, absolutely.
And why are we holding back some information? I mean, sorry, let me rephrase it. You can't, based upon your massive $1 million rollout of product based on a podcast series, that's a bit silly, I think. Don't you think?
Look, we don't know everything.
And we can't say everything either. The things that we do know, we cannot say it online here. We can't. I mean, I wish I could say that the bad names, the bad companies, and the bad strategies of certain groups out there in Australia who are selling, developing, financing, doing this, doing that. There are some pretty bad people out there in the SDA world. There are. And I see what they're doing. I hear the bad stories. Spookers, agents, developers, builders, financiers, whatever they are. I mean, I'm just using examples here of everything, but there are a lot of people who are doing the wrong thing out there. And the victims are the mum and dads. So please be careful with who you talk to, who you listen to. Be mindful that we're only holding back, some parts of what we know ourselves. If you want to talk to us in the office here in Brisbane, come meet us face to face. We have nothing to hide. You want to talk to me or Debbie and the staff here, give us a call on the phone number. We're happy to talk to people because we don't want to see people get hurt, Debbie. Agree?
Absolutely. And that's what it's all about at the end of the day. We want the industry to be a positive, fruitful experience for everyone investing in it. And we want to see participants get housing options that suit them in the right locations. And that's what it's all about. Unfortunately, there's big money in this and it does attract, when there is big money, it always attracts some people doing the wrong thing.
But it also attracts a lot of people who are not aware of them doing the wrong thing and they get sucked into it and lose their life savings as well.
Yeah.
Debbie, you and I have seen so many people, promote on Facebook, do podcasts, do vodcasts, and do all sorts of things out there in the SDA world. Now they've all disappeared now. Look online, look on YouTube, look on Spotify, look at all our competitors who were doing SDA. They're all gone quiet now all of a sudden.
There's a couple out there sort of pivoting, trying to do different things.
Fund managers. Everyone's being a fund manager now, apparently. Everyone. Not us. But yeah, just be very careful, everyone. Property trusts, property syndicates, funds of funds, managed funds, whatever it may be. I think, because I've come across this PDS from this new startup fund manager who I know is a negative player, spooker in the SDA world. I'm just concerned about people falling victim to their marketing tactics, And I want to quote something that he said to one of his staff members, this person I'm talking about, He hired a participant tenancy officer in his business, and he hired a bartender. And when one of his staff members questioned his decision to hire a bartender, his response was, well, if they can handle drunk people at a bar, they can handle disabled people as well. That was his exact comment to this person who told me face to face, right? And now they've launched a fund, an AFSL licensed product, right? Who are now active in the Perth and the Southeast Queensland market, which are bad. Debbie, tell me, of all the places in Australia to jump into for SDA, for a startup fund manager,
Not Perth or Southeast Queensland.
do not go into Southeast Queensland, do not go into Perth, because they're the worst markets to go into now.
Unless you know exactly what you're doing, and that will change in 3 months. So no, they're the wrong areas for a start. But it's all comes down to buyer beware. But if you are looking at these funds with interest, be very, very careful.
As always, we're going to promote our service, Debbie. Debbie, if anyone's looking at these things out there, can they contact you and our team to review?
Absolutely. Our research team is all over different products. We haven't reviewed a trust as yet. I'm sure we can look into that. But anything that you're looking at doing, come and speak to us.
Because we know who the people are in the background doing these things. And if we don't, we can always ask around as well, because it's what you don't know that will unravel your investment. Correct, Debbie?
Yeah. Yep. We will help you find where it could go wrong.
There's an example of a lady called Leonie, Debbie, recently.
Mm-hmm.
Tell me more about her and you. And
Yeah, Leonie she's an experienced SDA investor. She's already got a couple of investments. She's looking at taking on a couple more. And she was working with a developer who has an apartment complex already under construction. And the agreement...
18 months away, by the way.
Yeah, but it had started. So the agreement was that she would get 2 of the units converted to SDA, and they were the only 2 units in the entire complex. That was part of the agreement that they would have to abide by if she was to buy these. She came to us. We did a product analysis report. Look, it turned out that the location, all of the data was fantastic. It was in a brilliant location. However, we were also aware of quite a few other properties in the same suburb that were either new to market or close to coming to market, and also finding out about the developer and just some other issues in the background that she had actually started to suspect, which is why she come to us in the first place. Is this the right thing for me to do? And we gave her an unbiased report covering all the pros and cons of that development.
And I want to say, Debbie, just my 2 cents worth here, having 2 converted to IL in the building sounds good in theory, but from a SIL provider servicing point of view, having 2 in one building with no OA, it just doesn't make sense for it to work well when there's could be more HPSs in the same location. We'll just take priority, right? Priority as a service, SIL provision, care service in the local area. So there are things that we see very clearly, but investors don't see. And we want to make sure that you, our listeners, can understand that. We're here as a sounding board to give independent advice if you want to get independent advice. And we don't want us to be able to make mistakes. That's all we want to do, yeah.
Yep. Well, I think that wraps it up.
Yeah.
Do you have any more last words?
So Debbie, the summary of this topic today of property trusts is what? What's the summary here?
Buyer beware.
Buyer beware.
Investor beware. Really.
And if the money goes in,
don't expect to see it again.
Wow. Expect low returns and expect that there'll be delays in getting your money out because it takes time to get money out.
Yeah. So just do your research. Get all the advice, independent financial advice, legal advice, to make sure that what you're going into is worthwhile.
Yeah, cool. Thank you so much, everyone. Bye, Debbie.
Thank you. Bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.